Hello and welcome to this January 2022 investment outlook video from Fidelity. I'm Ed Monk and I'm joined today by the Outlook's author Tom Stevenson to answer your questions about where Tom thinks markets are now and where they may be headed in the months ahead. This time round, you can watch Tom run through his analysis of each of the main investing markets in a series of videos that are collected together online. You'll find them at the Markets and Insights section at fidelity.co.uk. Now, Tom, as always, we've asked Fidelity investors to submit their questions to you in advance, and I'm pleased to say that a great many of them have done that. I'll just add here that these are Tom's view of the market. It is not investment advice, but should be seen only as guidance. That said, let's get into the questions, Tom. Here's the first one. Markets seem to get spooked by inflation, but if you look at history in general, often the highest returns on stocks are when inflation is higher. So why the worry? Surely it's cash that's the asset to be concerned about during higher inflation.
I think it depends how high inflation is. I think it also depends on what's driving inflation. If inflation is a consequence of growth in the economy, high demand in the economy, then that can be a good environment for shares. I think the problem arises when inflation moves beyond that sort of moderate level of price rises. And I think at the moment we've got inflation running at about 7% in the US, not far behind that in Europe and in the UK. I think at those kinds of levels, then inflation starts to become a drag on growth, and it also starts to eat into the value of money, and that can be a problem even for shares.
Yeah, and it's true to say, isn't it, Tom, that inflation and as that filters through to interest rate rises as well, that has a knock-on effect for certain fixed income assets, of course, which is not the stock market necessarily, but some parts of the stock market will behave in a similar way and will be hurt by that higher inflation.
Yeah, no, you're absolutely right to point out that inflation and rising interest rates are really a problem for fixed interest rates, fixed interest investments like bonds, for example. And that's because, as their name suggests, they have a fixed income, they have a fixed return of capital at maturity. But there are some parts of the stock market which behave in a similar way. And indeed, some of the more growth-oriented parts of the stock market, such as the technology sectors, have seen their prices driven higher on the back of an environment of very low interest rates, which makes their future earnings more valuable in today's money. So if we do get an environment of persistent inflation and rising interest rates, then that is likely to make life tougher for those kinds of stocks. And they, of course, are the kinds of stocks which have driven the market higher in recent months.
Okay, well, inflation is a theme of these questions, Tom, so I'm sure we're going to return to it. Let's move on for now. Here's the next question. It says, "Hi, Tom. You always recommend keeping some dry powder to take advantage of stock market corrections. You also recommend keeping some cash in a rainy day fund to avoid having to sell units when their price is falling. In the face of inflation at 5%, just how much cash should we keep handy? Or what percentage of our portfolio should we keep in cash?" So what about that one?
Yeah, well, I mean, I absolutely stick with both of those recommendations about having a rainy day fund and also having some dry powder in just in case there's more volatility in the market, so you can take advantage of falling prices. The absolute level will obviously be determined by your own personal preference and your own personal circumstances. But it is fair to say, as the questioner points out, that with inflation at 5%, any money that you are holding as cash is going to be falling in value in real inflation adjusted terms. So that probably argues for minimizing the amount of cash, but to make sure that you have enough for both of those purposes that we've outlined. I think anything more than about 10% in cash is probably overdoing it, but you do need that much if you really want to take advantage of the volatility which we've already seen so far this year and we're likely to see in the rest of the year, I suspect.
Okay, Tom, well, let's move on. This is question number 3. Do you feel the UK investment market is undervalued as it has not seen the growth levels of the US stock market? And if so, do you think some catch-up will occur in 2022? So, the UK.
Yes, I do. I do think that the UK market is probably undervalued. I mean, there are good reasons why the UK market should be cheaper than, for example, the US market. We don't have the same exposure to those high growth sectors such as technology, and we also have a high exposure to some sectors which are naturally more lowly valued, the financials and the commodities companies, the miners, for example. However, I do think that the divergence has been, such that we're starting to see some real value in the UK. So if you look at the relative valuations, the US is valued at about 21 times expected earnings. The FTSE 100 is valued at about 13 times expected earnings. That's a pretty big differential. It's not quite the same with the FTSE 250, for example, which is a more domestically focused index, as we've discussed many times. That's trading at about 15 or 16 times earnings, but even that is much cheaper than the US market. So yes, I do think there is real value in the UK at the moment.
And Tom, just further to that question, you've put the case there for the UK being undervalued, but do you see a catalyst for unlocking that and a re-rating of the UK? Is there something on the horizon that might make people take a bit more notice of Britain?
Well, I mean, I do think that the UK market is quite exposed to sort of some cyclical sectors which will do well as the economy picks up. So I think the catalyst is probably the end of the pandemic. As we move back to a sort of sense of normality, then I think the kinds of sectors which we do have a heavy exposure to in the UK could do quite well. So that is probably the key to outperformance by the UK, a move towards more of a sort of cyclical value focus within markets rather than growth.
Okay, well, let's have a look at the other side of the pond then, Tom, in this next question, which is this. What are the chances of a US market correction given high valuations and a hawkish Federal Reserve?
Well, I mean, there is a chance of it, and I do think that the US market has been driven in particular by those technology stocks, which are most at risk of a significant rise in interest rates. Now, do I think that interest rates are going to rise more quickly than is already priced into the market? Not necessarily. It may well be that those rises come a bit sooner, but I think the scale of the increase in interest rates is baked into to valuations. And I think that the Federal Reserve, frankly, will struggle to push interest rates higher than it already thinks. About 2.5% is the Federal Reserve's assessment of where interest rates will end up. The futures markets think it's going to be a bit lower than that. So actually, I feel that the interest rate part of the equation is pretty much priced in.
Okay. Well, let's move on, Tom, to something completely different. What place do you think, Tom, crypto has in a balanced portfolio? And we had a few questions on this. So what do you think?
Well, I mean, you look at what's happened to crypto in the last 3 months. So, back in October of last year, Bitcoin was trading at nearly $70,000. It is now not much more than $40,000. So, a lot of people talk about crypto as having a role to play in an inflationary environment, being a safe haven in that kind of environment. I think the volatility that we've seen from Bitcoin this year really sort of argues against that. Now, plenty of people say that the cryptocurrencies could go much higher. I've seen predictions of $100,000 for Bitcoin. It's entirely possible. I simply don't know. But for me, the volatility is a problem. I'm nervous about investing in something which can move from 30 to 70 and back to 40 in no time at all.
Yeah, that's right. And that volatility, Tom, I guess really suggests that in terms of a place in the portfolio, at the margins, I guess, because you don't want the bulk of your money moving around like that.
Yeah, absolutely. So, I think there's a good argument for having a little bit of cryptocurrencies because we simply don't know what the future lies. And if Bitcoin does go to 100,000, then you're going to be pretty annoyed that you didn't have some exposure. But for me, it feels like a very small part of a portfolio, if any at all.
Okay. Let's move on. The next question, Tom, is this. Is there ever a good time to invest in bonds? It seems every economic factor or indicator, quantitative easing, interest rates, inflation, etc., ends up being bad news for bonds. So, what is the case for bonds these days, Tom?
Well, I mean, there are times when it absolutely does make sense to invest in bonds, and we've had a 40-year period when it's made complete sense to invest in bonds. They have been a fantastic balance for a portfolio which has been predominantly in equities, in shares. I think that now is that argument is no longer the case. However, having said that, bond yields have moved a lot just in the first week of this year. They've moved from 1.5% on the 10-year Treasury up to 1.8%. When we start getting up towards 2%, that's a reliable income. You know that the US government is going to continue to pay the interest rate on those bonds. So there is a point at which that income starts to look interesting to many investors who have a need for a reliable source of income, pension funds and the like. So, it becomes self-correcting in a way. If bonds fall back much further and interest rates start rising up to 2% and beyond, then I think, yes, they do have a place in a portfolio. But at the moment, it feels like that correction hasn't yet taken place. It feels like we're in the early stages of that correction. So at the moment, I feel pretty cautious about the bond market.
Okay, well, the next question, Tom, is related, but looks at some of the alternatives, perhaps. It says bonds or fixed income funds seem to be very out of favour at the moment, and certainly the idea of the 60-40 split in a portfolio now seems outdated. But do bonds still have a place? Is there any new model emerging to replace the old accepted 60-40 split?
The beauty of the 60-40 model was its simplicity, really. I mean, it was a sort of more or less half and half, a bit more shares, a bit less bonds. It was a nice, big, liquid market. It's very easy to invest in the bond market. I think the alternative sources of income are a bit more illiquid. They're a bit harder to deal in, but they are there. I mean, real estate offers a reliable yield, some infrastructure, some private equity. There are other ways to spread your money around and to get that diversification. But I don't think we should kid ourselves that it was a lot simpler when you could simply do it with some shares and some bonds.
Okay, well, let's move on, Tom. The next question is this. Hi, Tom. Would you recommend taking a profit from investments that have had a positive run and using that profit to diversify, or would you recommend leaving the profits in the original investment to compound? But is that increasing my risk? And it also says, thanks. By the way, I enjoy your podcast with Ed Monk. I thought I'd just get that in, Tom. Bit of flattery.
I enjoy my podcast with Ed Monk as well.
So should you sell out or run your winners?
Well, I mean, I think you can do a little bit of both. I mean, I think it makes sense to rebalance your portfolio from time to time. However, I do believe that, momentum is a powerful force, and that just because something has gone up doesn't mean that it's necessarily going to stop going up. I mean, you can the list of great investments which have gone on for years and years and years, compounding their growth is long, and so I would caution people about selling stuff just because it's gone up, and recycling that money into out of favour stuff which you hope will go up. So, I think, yes, think about rebalancing, taking a little bit of money off the table, maybe, and repositioning it. But don't do that in an extreme way, because things that are going up do have a habit of continuing to go up.
Okay. Well, let's move on, Tom. And this question was on the minds of a few people that emailed in. It is this: what could the effects of either a Russian invasion of the Ukraine or a Chinese invasion of Taiwan have on investments, and how best would it be to reduce the potential impact on a portfolio? So, geopolitics, how do you account for that?
Yes, I mean, I think, geopolitical risk is always a factor. I think at the moment it's probably an increasing factor this year. I mean, there are lots of things to worry about, and we've talked about many of them already. We haven't talked about geopolitics, but the saber rattling both in Asia and in Europe is definitely a concern. How do you get round that? I think there are some investments which have traditionally acted as safe havens. We haven't talked about gold yet, but that is one, I think, which has not performed over the last year, but could well be a source of stability, a port in the storm, if you like, were we to see a deterioration in the geopolitical landscape.
And just further to that question, Tom, I guess it's a reminder once again about diversification, as you say, and having your attitude to volatility sort of calibrated correctly. If we were to get any of those events, it would be obviously very big news. There would probably be a very negative reaction, but then there would be a sort of a calming down, and people would take better stock of what the likely effects were. You've got to keep your head in those sorts of periods.
Yeah, absolutely, because I think the initial reaction would undoubtedly be negative, but I think diversification is important, because different assets and different regions would be affected in different ways. And then also there's the element of timing. That there would be an initial reaction and then possibly a bounce back once investors really started to assess what the real implications were. Very easy to be on the wrong side of both of those moves. You might be too late to get out and too late to get back in, and that is frequently the way things pan out. So better to keep calm and just allow that reassessment to happen without necessarily wanting to participate in it yourself.
Okay. Well, Tom, here's the last question for us today, and it is this. Would it be sensible to sell or to avoid emerging market funds with interest rates tightening expected in the US? So, emerging markets, what's the outlook?
Yeah, I mean, it's a good question. Emerging markets typically do not perform well in an environment of rising US interest rates, which is possibly accompanied by a rising dollar. A stronger dollar is hard for companies and households with dollar-denominated debts, and that's typically the case in emerging markets. That said, last year was a very poor year for emerging markets, a very poor year in particular for Chinese shares. And I talked about the differential in valuations between the US and the UK. We've got similar differentials with other markets, Japan, Europe, but also with emerging markets. Emerging markets have derated over the last year. They're now look pretty fair value given the outlook. So I am less negative on emerging markets than I was.
Yeah, and further to that, Tom, it seems a question like this is at root actually a question about investing timelines and time horizons, because if you were able to jump into the future and look back at the best times to buy, for example, emerging market shares, it may well be when everyone's very, very worried about them. A lot of that is going to be priced in. They've mentioned the tightening of Fed policy. Some of that's going to be tightened in when it comes to emerging markets already. If you're able to actually invest through these periods, that's when you can really get the benefit of these markets, which tend to deliver their returns in quite a lumpy way. We've had some fallow years. You don't really know when the next good year is going to come. Yes,
and you're right to point out that these things move in unpredictable ways and in lumpy ways. And if you try and time those moves, you'll probably get it wrong. And that is the argument for being well diversified, because if you have a spread of investments across all these different asset classes and across these different regions, when they have their moment in the sun, you will be there. Okay, you might not be there 100%, but you will definitely be there if you have a good spread of assets. And that's why we talk about diversification such a lot, and why it's so important.
Well, that's all the time we have for questions now. Thanks to Tom for joining us today to answer them. If you asked us a question that we didn't get round to answering, we have a special edition of the Money Talk podcast which will answer yet more questions. You can listen to that on iTunes or wherever you get your podcasts, and a full copy of Tom's investment outlook is also available to download at fidelity.co.uk. Thank you so much for watching, and do join us again next time. Bye for now.